Hello and welcome. You're watching the Smid Show here on NDTV Profit. I'm Harsh Saita. With me is Anushi Vakaria. And we're going to speak with the first management. We have Sanghvi Movers here. We have Mr. Rishi Sanghvi, who's going to talk to us about a whole host of factors playing out for Sanghvi Movers. Welcome, Mr. Sanghvi. First off, want to understand, you're splitting your business up, of course, into your own subsidiaries. You're not planning to list it separately, but talk to us about the rationale behind that, this business restructuring that you're doing.
Hi, good morning, and thanks for having me, Bhavik. Sanghvi Movers Limited, which is the listed entity, is the first crane rental company in India and the fourth largest in the world. So we are a 3 decades old business, and we have started offering value-added services to our renewable customers as well as our hydrocarbon customers. Now, those businesses have gotten to a certain size and scale where we see a lot of value creation that we can do for our customers. Specifically in the renewables, we are providing turnkey solutions from commissioning, conceptualization to commissioning. And therefore, we have hived out our capabilities into a 100% wholly owned subsidiary, Sangreen Future Renewables, and in future, we will continue to build our capabilities within that company and deliver turnkey services to the renewable space.
Mr. Sanghvi, hi, Anushi joining in here. I wanted to understand more on the turnkey business that you've mentioned. You've earlier said that there are a shortage of players in this wind turnkey solutions that we are looking at. Want to understand the competitive landscape on this, and also want to see, is there a possibility of a separate listing for these two companies, these two new subsidiaries that we've made in the future?
Right. Hi, Anushi. So the competitive landscape in the EPC or turnkey services space in the renewables sector is quite competitive because the renewable sector is on fire, and it is, trending currently, and it's the flavor of the next decade. However, there are very few organized, listed, well-governed companies who can deliver projects on time and within cost. And for these independent power producers, mainly who are pension fund backed, who are private equity backed, or who are foreign utilities or Indian listed entities, it is very hard for these large players to work with unorganized service providers. So while the space is large and there are a number of customers, there is a lot of value differentiation that can take place. And that's why we believe we have an edge, and we are delivering services under Sangreen Future Renewables. With plans to list the companies, right now we are focused on delivering value to our customers, aiding the country in its clean and green energy transition. And if there is a value play or a proposition to deliver further value to our shareholders, then we may list the companies in the future.
All right. Let me switch focus. Let me come to the Q1 numbers and talk us also through what we can expect for H1 or the rest of the year, if you can. So Q1 was a slightly softer quarter. Give us the perspective as to why that is so.
So, there's a couple of things that are happening in the economy. First off, there was a general election, so there was a slowdown. Both public sector capex and private capex took a hit in the first quarter. In fact, Q1 had a lower GDP growth rate as was expected. Besides that, there has been an early onset of monsoons in the country, which has slowed the project execution and offtake on site. So we see this situation continuing, especially the slowdown due to monsoons in the second quarter. But looking forward, we believe that the second half of the financial year is where the demand for cranes is going to pick up. And we see all sectors, wind, steel, cement, hydrocarbons, petrochemicals, metros, railways, bridges, all of these sectors will pick up in the second half of the year.
Mr. Sanghvi, I'll come to the key operational metrics over here. So, as you said that Q2 is expected to be softer. Now, this is on the one of the key reasons is also the capacity utilizations, which will continue to fall from the 77%, which is lower than the 80% mark, and this will go below the 75% mark as well. And as a result of this, even the average blended yield will see a decline over here. Wanted to understand what would be the perspective on this post the Q2 for the second half. What can these numbers look like? Will they go back to the 80% plus range?
So yes, we expect the demand for cranes in the second half of the financial year to not only push up the utilization in and around 80%, but to also we expect to maintain an average blended yield of 2% through the financial year.
All right, and Mr. Sanghvi, Q2, you expect a bounce back? Because your Q1 commentary seemed to suggest that Q2 will be softer.
Yes, no, we expect the monsoon situation, which has slowed down the project offtake at site, will definitely continue through Q2. And as I've already mentioned, we expect the second half of the financial year to look much better.
Understood. Understood.
So, Mr. Sanghvi, what are the revenue projections for the FY25 period as we speak? Are you still on track to meet the 950 to 1000 crore of the revenue guidance? And also give us an outlook on what the blended margins will continue to look like as we move forward.
Right. So we have already surpassed our order booking today stands at around 750 crores, and we still have a balance 7 months to build out that order book, which will primarily come in the second half of the financial year, where we expect demand to look much better for cranes due to the all the different sectors firing and project execution speeding up in the second half of the year. With sorry, go ahead.
Yes, please continue.
We believe that our order book today at 750 crores split between our core business and our EPC business, where 330 crores is from the EPC business. We expect to maintain the same blended average EBITDA, which we have given a guidance of around 50%.
Mr. Sanghvi, you mentioned that the EPC business consists of about 330 crore of an order. But if we exclude this and come back to the crane order book, now that has been on a declining trend. Want to understand your perspective if we take this we take this period into account and compare it with the previous year, why are we seeing a decline in these orders, and what is the kind of order pipeline that we are looking at, the inquiry pipeline that we should be looking forward?
Sure. So yes, there is an order decline because of two primary reasons which has been mentioned, which is the general election where there was a slowdown on government spend, but also private capex took a hit. And for the first quarter, the GDP is lower than expected. The second issue is, of course, the early onset of monsoon. It was better than predicted, and that has resulted in twin issues with respect to the project offtake and the slowdown in execution on the ground. We believe this to improve in the second half of the financial year, and therefore we believe that our capacity utilization will cross 80% in the second half of the year.
And overall capacity utilization will be 80% plus for the full financial year?
Thereabouts, between 77 to 80%.
Sure. So it will normalize is what you're suggesting, despite Q1 being slightly softer due to elections versus last year?
Yes.
Okay. I want to try and also understand the revenue breakup as you go about. So talk to us about full year FY25 top line. Where do you expect, you've suggested 950 to 1000 crore. How will that evolve in terms of product mix or service mix? Wind EPC, project EPC, how should one look at it? How should one view it?
Yeah, so you're asking for a forward guidance, which is something difficult for me to give.
I understand.
But what I will say is that our order book has settled at 750 crores, which is deliverable in this financial year. We have 7 months left to build the order book, and I believe it's during the peak demand for cranes, which is in the second half of the financial year. We do see our capacity utilizations increasing. There is tremendous order visibility or inquiry pipeline. From the wind energy sector, there's more than 10 gigawatts of inquiries that we are having right now. Not all of it is deliverable in this financial year, but all independent power producers are in touch with us, and the scale of the inquiries is vast. It's more than 10 gigawatts. Thermal power, cement, steel, petrochemicals, hydrocarbons, civil infrastructure projects that are being built around the country are all contributing to a very healthy inquiry pipeline. And I think going forward, we are well poised to capitalize on that inquiry pipeline and build up our order book in the last 7 months.
Understood. And with regard to project EPC, how will that start contributing to top line? If you can just give us some visibility there.
Right. So we are still in our nascent stage. So this year we are looking at closing the project EPC order book between 75 to 100 crores. Some of it may be spilled over into the next year, but this is what we're talking about in terms of order wins, not order deliveries.
Mr. Sanghvi, you've mentioned that you have a strong order pipeline in place for the EPC business. Will that explain the 50% growth that you're seeing for the new businesses, or there are other factors in play as well? And also, what would be the 2 to 3 year outlook? Like post this FY25, what should be the near-term scenario that we should look for the growth potential of these new businesses?
Right. So yes, you're absolutely right. You know, every single independent power producer in the renewable space has a gigawatt ambition per year, and everyone is looking to build out a 5 gigawatt platform. And so this has created a massive amount of excitement both in the wind and solar space. So the inquiry pipeline that we are seeing from the independent power producers in the renewable space will definitely feed into our businesses, and we expect the business to deliver 50% growth this year, and next year also looks positive based on the inquiry pipeline we have. Now, you know, as we build our business, we are developing a track record and a reputation of delivery. We're one of the very few EPC players in the country that are well run, positioned, governed, and are delivering projects on time and within cost. So our track record will enable us to capitalize on more opportunities going forward. And we definitely see this as a forward momentum that will drive this growth in our EPC business.
All right. Thank you so much, Mr. Sanghvi. That's all the time we have. But thank you so much. It's been a good chat. Thank you for coming in and breaking this down for us.